treat. We have David Parker, the founder and CEO of Covenant Logistics. David, I have a habit of saying Covenant Transport, so I got to get. I do too. Old habits. Have you done this to any of your investor calls?
Yes, I have.
So you guys just had your conference call. Congratulations. Yep. I understand this is the biggest revenue in your history.
Yes. Yeah.
So what do you? I mean, obviously the market's helping out. What do you attribute it to?
I tell you, at the end of the day, it's what we started 11 years ago, and refocusing the company and getting into the various segments. You know, we're not into the OTR segment, very little. Yeah. I mean, we may have 100 trucks running in the OTR segment, and we have really focused on the 4 areas that we're involved in, which is expedited, dedicated, freight management, and warehousing. Yeah. And we've been going down that path for a while.
So that's I mean, obviously over the last 14 years, you've talked about just the transition of the company. It is a very different operator. If you followed it historically, it's a very different operator than it historically has been. But there is something special about the way you guys have repositioned the business. What part of the business are you most proud of in terms of the progress that you're making right now?
Well, I tell you, number one, I'm proud of all 4 of them. If I leave one out, I'll get in trouble.
Love all your kids equally.
That's right. I love all my children.
I love 5 kids. It depends on the moment.
I love them all. I love them all equally. But you know, we've all of them have made some great headway. I look at our legacy dedicated that. We had them all down yesterday for meetings, and they have just done a great job. I mean, they have turned that thing around so well. I'm proud of them. There's no doubt that the freight management, which is quote brokerage as well as a small management of freight. It's been tough. We went from doing great until you couldn't find capacity, and then our margins have squeezed, and so we continue to focus on that to make sure that we can either raise rates or find carriers that do it cheaper. And I got a feeling raising rates is easier.
Yeah, well, look, misery loves company, because every public truckload carrier that we've covered has had the one part of their business has struggled, and you can go through the list. In fact, I don't think we've covered asset-based carrier that's done well in brokerage.
No, revenue has been up for everyone in brokerage.
CH is doing well despite all the noise. Yeah. RXO we're going to hear from next week. I would suspect they're doing well, but it seems like the asset side of the business, these logistics operations are there to serve the truck. Julie and I have talked about. Usually the truck is going to win out in terms of how you guys think about the business.
And that's interesting, because that is one spin. Ours really isn't. Our assets, keep it on, we do no OTR. So we're very focused. So our asset side only handles about 0.5%.
Wow.
Of the broker freight, and
So why do you think it's underperforming versus some of the other businesses?
Strictly because capacity rates have gone up faster than we've been able to raise.
So you have contracted business, that long short side of it.
It's about 70-30.
The spread of it's hard. It's hard in this kind of environment.
It's harder. And now eventually it's going to catch up.
Well, I mean, we're still early cycle. I mean, Julie and I were talking earlier on this call, every CEO's talked to, I think they all
use the same words.
Yeah. They read each other. Yeah. We're in the early innings. Do you agree with that?
Yes, I do.
Derek says that we're in the 3rd inning. Where would you describe it?
Yes, I believe that we've reached first base. I use baseball analogies. So we hit the ball.
We're still in the innings.
That's right. We hit the ball last October. Is when the DOT really started focusing, because of the August accident that happened in Florida that we're all well aware of. DOT took over in October, and to me that was hitting the ball, and I believe we're at first base. I think that we've got a long runway.
You think it's a long, big stadium?
I don't know if it may have been you all, to be honest with you, but whoever invented the term super cycle, I believe it. I believe that's where we're at.
Yeah, I think FreightWaves was one of the first to actually describe.
I agree with that.
That world is set in because it's exact. I mean, there have been, people have used that term in the past. I think we described it simply because you have the setup that's very unusual. I mean, the reality is that the driver constraint has always been the capacity constraint. It's interesting. You go back over the decades. Everyone talks about the number of truck counts. And I remember as a kid, and I'd listen to the conversations my dad would have about trucking. And a lot of it was how many trucks got produced, because you couldn't count the drivers.
Yeah, that's right.
Now, over the last decade, a lot of the capacity constraints have been truck drivers. But the issue has been this massive immigration that has been unrestricted, and the regulatory environment has eliminated all the barriers to entry, has meant that we didn't have a normal cycle.
We didn't.
That's all gone away.
It's all gone.
We talked about just the demographics and how all the fact that it is harder to recruit fully vetted, fully registered truck drivers today has made it more challenging.
Yes, and it's interesting. Who would ever remember the days that we're saying now, boy, I'm glad. I'm having a hard time finding professional drivers.
Yeah.
I'm having a hard time getting drivers in the seat, but let me tell you, after the last 4 years, I will take that any day.
Yeah,
Let that be my problem.
It's pricing power, right? That it gives you guys pricing power.
And it's not abusive pricing power. It's give me pricing power to be able to cover my costs.
So I'm going to ask you a question. Yeah. Is there a truck driver shortage?
My son-in-law and I argue about this all the time. He had his own recruiting company. I say no. He says yes. Only thing I know is I need drivers.
Okay, well, there you go.
Yeah, that's all I know. I need some drivers.
I think the pivot has moved from driver shortage to qualified driver shortage. Mm-hmm. The drivers themselves, by the way, you need to send your messages to your son-in-law, Rob.
Yes.
That they, for those drivers that are upset about the term driver shortage. But I think even the drivers would agree that there is a shortage of qualified drivers.
Yeah.
That's a big piece.
Yeah. We need more of them.
Julie, when we think about this market and think about just what Covenant is known for, you were at U.S. Express, two of the largest team operations. When you were reading the earnings, what was your perception in terms of Covenant's performance?
So, I think certainly, you can break it out by revenue per tractor per week looked excellent based on my experience. I assume inflated based on the amount of expedited freight and team freight you're doing. But I also noticed the theme that we're hearing from everyone else as well, that we're really working on increased utilization, increased profit, not any interest in growing fleets necessarily right now, more in likely shrinking the asset footprint. So that was sort of the theme that I noticed that I had read, not just in the Covenant earnings, but really kind of across the board.
It's different, right?
Yes, it is. And it's interesting. We took out 150 teams, trucks out of the expedited side in the first quarter. Now, some of that bit us in the second quarter because there's a lot of tail on insurance claims and some other costs that happened in December and January that you don't have enough revenue to be able to support it, and all of a sudden your fixed costs are not helping you as much as you would like for them to. But we took off. But I'm going to tell you, in my meetings yesterday, guys, because I know that we all sensed in the month of July a little pause. Whatever you want to call that.
We talked about it.
It happens every year, though.
Every year. Yeah. Every year.
But do you think did you feel, because we've been talking about this pause, this slowdown, do you feel like this is a normal season calendar thing, or do you think it's unusual?
No, it's a normal. But B, I will tell you that, let's say prior to the month of July, we had 3 loads for every truck. I'll just say that. In whatever division, brokerage or expedited, 3 loads for every truck. In the month of July, it's not that it became negative, it was 1.5. So we went from 3 to 1.5, and we're thinking we're in a depression. And I'm loading all my trucks.
About the cycle. Everyone's worried about overcorrection. Right? We're at 14.5% rejections, which a year ago we would have killed for.
Absolutely.
And I think it's hard.
Same thing.
We're just waiting. Everybody's waiting for the cycle.
And I will tell you this, though, exciting on from my standpoint, that I'm hoping is showing something, because I really expect that August will start going back the other way. I really do. And I saw numbers today for projected next week's revenue that will probably be our highest of the year.
Congratulations.
I hope that comes through. Now, that's just projections. So, we all throw projections.
If it's a normal cycle, by mid to late August, you're going to see record numbers.
Well, we are in late. I mean, it seems like early August.
Yeah,
I know, but
you're right.
It keeps growing. It keeps growing.
My memory's a blur. I'm not sleeping these days. I'm doing other stuff. David, you guys had one of the largest, if not the largest, team operations in the entire industry. How many teams are you currently running?
We have about 750 that are in that fleet. And I would say we probably need 20 or 30 more right there because of open trucks. So somewhere in that neighborhood.
I mean, at peak, how many teams?
Oh, we were at 1,800.
And what were you guys running at peak, Dad?
Well, when we started U.S. Express, like 20 or 30 some odd years ago, we were almost 80%.
But what was the number of team count? Where did you guys ever peak at? 2,000, 1,500?
Well, probably somewhere around 2,300.
Gotcha. Because you guys were, it was Covenant, U.S. Express, CRS2.
That's right.
And that was probably.
It was a 3.
It was the 3 of you guys that dominated. What happened to the team business over the decades?
If you go back and look at the history, my dad was one of the first people to really get into that long haul market from Southern California points east. So when David started Covenant, he started real heavy with teams. When I started U.S. Express, I was real heavy with teams.
Clyde was definitely.
And to a certain extent, we were bootstrapping that whole market. Because we had teams and hardly anybody else did.
Yeah. I think to answer your question also, though, I think what's happened over the years, and then we've also led an effort, and that to right size from a standpoint that I think the Amazon effect, warehouses got closer, you wanted it next day, et cetera. So that took down the team side somewhat. But at the end of the day, it comes this. To get the ROI on a team operation, you've got to be somewhere in the mid-80s ORs, 85, 86, maybe 87. If you want to get a good ROI, and that's what we started on, and says, customers, and my customers know, I love them to pieces. I don't make a dollar without my customers, so thank them for the ones. But we've actually gone to our customers and we say, listen, if you do not need these teams and do not want to pay me for these teams, I will get rid of them. And the market answered back in 2020 when the world came to an end, and we went from 1,200 teams down to about where we're at currently. And we're continuously asking that question, are you willing to pay? Because these teams, guys, let me tell you, every 18 months, okay, how much is Freightliner or Peterbilt wanting for a truck? Oh, another 8 or 10 or 12,000 more dollars. Think about how often I'm having to trade these trucks. And if you don't get the ROI, I can put them in my chicken business. I can put them in my dedicated business and run these trucks 5 years.
So the headaches, it's interesting. We need to get a segment with David called Hug a Customer, because we have a
I love them.
Webb Estes sent us a pallet. He was the inaugural
I do a
show.
segment just on the chicken business.
That's right.
Honestly.
We'll get into the chicken business in a while. We know Clyde and Max aren't eating chicken. Clyde didn't. It's interesting because you talk about the challenges of you're running these things, your high utilization, but the idea is with teams is you do get a lot of miles. What you're saying is a little different. It's the CapEx side that you have to constantly replace them.
That's right. We got to get the revenue. I mean, these trucks need to be generating about $10,000 a week on these trucks, not $8,500 a week.
So I've known you guys,
and the
both of
drivers
you.
work so hard.
They work so hard. It's a hard job.
Well, and you're also talking about, you said first quarter was kind of down on teams. Well, that's every year. So it cycles in and out.
In and out.
So you have to constantly adjust up and down.
That's right.
In order to keep that count at the right count.
So I'm going to ask both of you guys. By the way, they are step brothers.
Yep.
Clyde Fuller, Freight Caviar did a fantastic.
It was good.
A fantastic cover on Freight Alley. Credit. This is a countrywide. There's Clyde. He's the bigger than life character, sort of like Boss Hogg is how I describe him. Big old cigars, bigger than life and bigger than reality. But he had these old cab overs that, in my opinion, went hard. Both of you guys, growing up, I've known you both my whole life. There was this rivalry in Chattanooga of building two big companies, two big trucking companies. The family dynamic plays into it. But the truck count was also a piece of that. Who had the most teams? Who had the most trucks? David, you've talked about this change in direction, the fact that you guys have become disciplined. When did you decide that the number of trucks just did not matter?
Yeah, when my prophets told me that. I mean, first of all, in 40 years of being in business, I've been broke 2 times and just didn't shut the doors. And every company probably at one time or another has been broke and just didn't shut the doors.
Yeah.
And so you're continuously looking about how do I revamp the company and how do I make sure that we're going to be longevity and that you're going to continue going. And so it was all along those kind of lines that made us make all those kind of decisions. It says, here's who we need to be when we grow up. And so in 2015, when I made that decision, went to the board, and what I told the board that day was this: I'm so tired of the up and downs of my earnings. Let me tell you, one good thing about a team operation, when it's running like a third shift manufacturing, you're printing money. But let me tell you, let the weather in January, let the GDP go to 1 instead of 2.5, and you don't have the freight, you are not making those widgets 3 shifts, and all of a sudden that cost. Too many people in payroll, too many mechanics to fix my trucks. The cost just kills you, and your margin, you can literally go from 83 ORs to 97 ORs in a week.
Well, Wall Street is awarding you, this is in 2008, your stock was as low as 78 cents a share.
Yeah.
There was a belief, this is 2008,
Absolutely, we're gone.
that you guys might file bankruptcy at some point.
Yeah.
You were on bankruptcy watch.
Yeah, that's right.
You've now got nearly $1 billion market cap. Your stock has been, it's right up to the right. We're up and to the right.
Yeah.
The Wall Street is awarding you, but you're a smaller, revenue's there, but in terms of total truck count, you're smaller.
Yeah.
When you decided to go on this journey, how painful was it to think, and I'm making the right decision in terms of getting out of the OTR business?
Yeah, it wasn't. Again, so in 2015, went to the board, I said, I don't know what this means, but here's what we're going to do. I'm going to get deeper in the supply chain. Have no idea what it means. Thank the Lord, Delta Airlines came up there, and Delta, which we're still with them 11 years later, Delta wanted our teams to haul their engines and their tires out of Atlanta, Georgia, that had to be in LaGuardia, had to be in Minneapolis and Chicago, Detroit next day. But they also wanted me to do Chattanooga, Tennessee, and Columbia, South Carolina, and Auburn, Alabama. Every location for Delta went to. And so when you land in Atlanta and you look over there where they're working on planes, we got people in there and have for 11 years. Since then, we're now operating a warehouse for Delta Airlines, and that started it. It was a blessing. I don't know if Delta sold me or I sold Delta, because they were scaring me when they was telling me what they wanted me to do in 2015.
David, if my flight's delayed or it's a maintenance problem,
the first thing I do is this plane because of tires or brakes?
Okay, that's where all of its tires and brakes.
Tires and brakes.
Interesting. Well,
if it's tires and brakes, it's me.
By the way, we need those.
That's right.
We need tires and brakes.
We got to have them.
Brakes especially. I've had my brakes fail on my own airplane as a pilot. Tort reform is a big conversation.
Yeah.
We have been covering back to back. Matt Leffler and I are going to get into torts. So he is going to talk about this whole legal situation happening in freight. But this all comes down to the fact that no matter where you're at in this, you are subject to these massive, massive lawsuits. Yeah. What are you hoping that the government does about tort?
I heard Max say earlier that if we don't get tort reform, it's not going to matter. I'm paraphrasing.
That's right.
And it's true. Right. It's not going to matter. That's why I believe we have to get it. I am so happy with what DOT, but I'm happy with what ATA, Chris Spears is doing, leading this effort. I have probably been to Washington 6 or 7 times since October, and I'm very blessed in one side to have Ben Carson on my board that allows me to get some meetings when I need some meetings. And we are running with that effort to get tort reform. And I will tell you, we've went from forever, all of our careers, 0% chance of getting tort reform. I got it at 20%, only because of Donald Trump. Only because he knows it's affected him in court cases. Only because he knows how hard it has been. And we've been fortunate enough to meet with him 2 times. We've been fortunate enough to meet with the Judiciary Committee 2 months ago. We have met with Jim Jordan 2 months ago. We're going, and I think I'm happy at 20% chance.
Well, look,
But it's got to happen.
It's got to happen.
If it doesn't happen, we're not going to have an industry at all.
Yes, you
I mean,
can't have this.
these cases are coming on so strong and so hard against these carriers, and it's destroying their balance sheets.
Yes, it is.
well, the risk is, I mean, the insurance numbers are piling up. How much does insurance cost you more? Are you having to deal with insurance changes over the last?
Let me tell you, thank the Lord, a couple of things. Ours does not expire until next April. But in the last 3 or 4 years, we've got 50% of insurance, and my costs are up about 300%. 300% cost for 50% of total coverage. And guys, I'm going to tell you, I don't know what kind of insurance any of us got. I mean, it's like I'm naked on this quarter. We're dividing it by 2 on this quarter. As it goes up, the exposure just gets larger and larger.
Well, the problem is that the courts are awarding such large awards that the insurance companies have to continue to increase their charges.
Yeah.
And the carriers are having to, in order to keep the costs down,
Yes.
are having to take bigger exposures.
Yes.
And I mean, that's a big problem for this industry.
It's
You know,
an
we
uncertain
got a
risk.
problem with returns anyway.
It's a major
and then you
problem.
compound it with that. I mean, it's got to happen.
I got to tell you, having been around this industry, grown up in a trucking family, have diesel in my blood, the thought of having to deal with this unknown risk of what this means,
Yeah.
the pressure, for any operator who's got risk out there and these existential risks, it just seems like it's a lot to stomach.
It is, and as Max can relate to, and all of us can relate to, and that is, what's the first thing we wake up of a morning? The first thing we do is get our phone to see if we had any bad accidents, right?
I used to do that every morning.
Every morning, and the
Yeah.
first thing
I
you do,
don't miss that every morning, like checking if I got any alerts or emails overnight of anything.
know.
What do I need to know? I mean, look, I think there's an argument that some of the unregulated parties that are out there having the more regulation, more risk management is important. There's definitely this industry's gotten too loose.
Yeah.
But when you're talking about the fact that we've covered multiple stories, there's the Utah nuclear lawsuit with now QXO, one of Brad Jacobs' companies, Beacon Roofing.
Yeah.
The jury decided that the driver was not negligent, or the carrier was not negligent. Still, Matt Leffler, we have Matt Leffler. Matt, that whole story was absolutely insane that the jury decided that the carrier wasn't negligent, but then still awarded an $86 million nuclear judgment against QXO. What was that nonsense?
The key to remember in all this is that juries get it wrong, trial courts get it wrong, and that's why you have an appellate process. Ultimately, these things take years to unpack. It'll be the same case with C.H. Robinson in Dallas. So even though you might get a verdict, like that doesn't make any sense. There's going to be appeals, there'll be change, but you might not hear that for a year or 2 years down the road. That's why it's so dangerous for motor carriers and brokers right now. You just don't know where the cards are going to land.
You just never know what the risks are, and that's the issue. I mean, we there's so many cases in terms of just this unknown risk, and a lot of times it's just up to the jury. Emotion, these plaintiffs' attorneys get all fired up and get people fired up, and it's a big issue. Matt Leffler, we're not going to dive into that. Stay tuned later for Freight Expectations. Real quick, I want to ask David a couple more questions. Production, just calm down. We don't need the music just yet. We'll get there. David, what is it that you're most excited about right now in this industry?
Where the cycle is, and quote, the super cycle that I think is at the beginning stages. That's the most exciting
Do
thing.
you think this is going on for years? Do you think it turns over in a year? Like,
No. I think it's, here's what I believe. I believe what the DOT has done is unbelievable from a standpoint, and you've had Derek Bars here, and that is, we don't care how much money a trucking company makes. We don't care how much money the customer makes, a shipper, a manufacturer. Here's what we do care about, is that the motoring public knows that the safety is on the interstate when they pass a truck. That's her whole goal, and they don't care about what that means. He is driving that process. Doing that, I believe, has taken out somewhere between 2 and 3% of capacity. Keep in mind, 2% moves the market.
Look, John Kingston, our oil reporter who's been reporting on commodities his whole life, has argued, and he educated us. it is not the percentage that matter. It's the incremental. As he says, the incremental barrel of oil sets the oil price. Same thing in trucking. You need in any market, if you have one more load than you have a truck, people pay whatever. And that's why these markets can flip 20, 30% in a given hour.
Absolutely.
A given day.
So let's say that they've taken out 2 to 3% of capacity. I'm saying we're at first base.
There's a lot more coming.
I think there's a lot more.
And
You and I are aligned on that totally.
Yeah, a lot more is coming. The regulators, whether we're talking state, government, and look, we've had conversation with Derek Bars, we've had conversation with DOT. The fact is that just like the STB, and we had our rail summit earlier this week, we had the benefit of Union Pacific and Norfolk's CEOs here in Chattanooga, along with the chair of the STB. What they've said is one of their roles as the STB is to stabilize the economics of the rail industry, because they said this is one of their charters. If they don't stabilize the economics of the railroads, and we all saw what happened in the 80s,
yes,
then you're going to have safety issues. And so having an economic return, given the benefit of companies that operate safely to make investments. And that's the other problem. When you can't operate safe and you got to deal with a lot of the cost increases, inflationary issues, and you haven't made a profit because of this excess amount of capacity, even though, and look, companies like Covenant, companies like US Express, the companies that we're covering, they had no choice but to make these safety investments.
You have to.
But it's that mid-market carrier that oftentimes will sacrifice the investments in training and in equipment.
Yeah.
Matt Leffer likes to remind us that 1/5 of all trucks on the road are not roadworthy because they're just trying to stay in business. And that is not what you want if you're a safety regulator. Your responsibility is to keep the trucks safe on the road, but the companies must make a return. And you're we're bragging about the fact that I know this is great, and I don't mean to dismiss it.
I know.
A 96 OR?
I know.
Pathetic. That is not great in the world of companies. Congratulations, by the way, but that's the fact that it's 96.
It's pitiful.
Tells you everything you need to know about how
We got
hard
to
it is
do
to make
better.
Well, what people don't understand about ORs is you almost have to make at least a 92 just to break even.
That's right.
Because you got to pay your
Most
working
shippers
capital
think
debt.
when you say 92 that you're making an 8% profit. That's not true.
No.
You've got interest, you got taxes, you got all kinds of things that gets added to it, and it really takes at least a 92 to break even. And this industry doesn't break even very often.
I would love to track, we should do this at some point. We'll have you back, David, to track the history of Covenant and US Express and other carriers and how many times you guys actually got to 92, because the history is
all 5 times.
you have these businesses that are among the most successful, have all the benefits in the world, and you're just struggling to have oxygen.
I know.
It is a difficult, brutal.
But it's getting better.
It is getting better.
I
do hope that
that's the closer of that, is that the FMCSA, the DOT, we know that they've asked for our data. They use it to ensure freight market health, right?
I got a text. I don't know if Derek wants me to share this, but I'm going to anyways. I was sitting down here with Weston Wamp, our county mayor, Mitch Patel, he's one of the local hoteliers in town, and I get a text message from Derek, call me. And I'm like, okay, the guy in charge of the FMCSA, the primary regulator, I probably should step out of this meeting. No offense against Weston Wamp, our county mayor. I thought that maybe Derek Barge is a little bit more important. So I step out and I'm like, what's up, man? He goes, I need to know how rates are today. So I told him the NTI rate. And he goes, what were they pre-regulation? Pre-COVID. And I told him the NTI rate. And I said, Derek, what's going on? He goes, the White House wants to know. And I think this goes back to the fact that the regulators, and I use the STB as the example of this, understand that when you don't make a profit, when this industry isn't making a profit, we clearly know you aren't making the kinds of investments.
Yeah.
You can't invest in safety. You can't invest in new equipment. You can't invest in quality drivers.
Yes.
Not the big companies that are cutting the corners. It's the mid-level operators, those family businesses with hundreds. Carol Fulmer went bankrupt.
Yeah.
They went bankrupt because there's too many drivers on the road, and many of them are unregulated. And what's not fair, David, is that the government allowed non-regulated entities, non-regulated drivers to make lots of money, super ego, rented money.
Yeah.
They weren't operating compliant. You guys are just struggling to survive.
That's right. Absolutely.
Man, we could do this all day long, but Matt Leffler is in the box waiting to talk about the biggest story in freight, which is all of the regulatory lawsuits. And because we are generous here at FreightWaves today, we are giving you free legal information, not advice. As Matt Leffler likes to remind us, if you're using Matt Leffler as your attorney and you're not paying him, you need a real attorney. I mean, you're a real attorney.
He's a real attorney. He's just not working
You're
for
a real
you.
attorney. What was your quote, your favorite quote?
If you think you need a lawyer, you probably do, and I'm not your lawyer unless you're paying me. Then I'd love to represent you. So yes, I am a real life lawyer, but I'm not your lawyer.
No one is paying you on FreightWaves today, so just use his advice. That's the disclaimer. We'll be right back with Freight Expectations. David, thank you so much for coming in.
I'm glad to be here.
Always congratulations on a great quarter. We look forward to having you back next quarter to tell us all the great things.
Come back anytime.
It is fun to talk to the two of you guys. The newspaper, I bought the Times Free Press for our audience that doesn't know. It's the local newspaper here in Chattanooga. They're going to do a story on Sunday. I was talking to the reporter. He's in this conversation about the history of the family, and I was telling him about Clyde and David and Max, you guys, and he asked a question: was it always friendly? I said, not so much. And so in the 90s, in the early 2000s, there was a lot more rivalry. You guys were arm wrestling and competing.
You know, the thing is, though, Max and I always loved each other.
We do.
We did. We always
And
loved each other.
If I couldn't haul the freight, I want him to haul
That's
it.
right.
I don't know if that's true. I'm going to go back
No,
and
I
find some
did.
people to dispute that. We're going to fact check that all
There's
because
a
I know
story-
better than that.
There's a story behind it.
There's a great story behind it. We'll be right back.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference, it's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else, the connections that change the trajectory of your business, the relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
For today's Sonar update, we're going to talk a little bit about contract versus spot savings, as well as intermodal savings. We didn't get a lot of time on yesterday's show. It was packed to talk through some of the things we're seeing as far as intermodal savings and some of the really cool features of our intermodal dashboard. We are live today from the College Football Hall of Fame, but wanted to ensure we still had time to give our daily Sonar update. So we're seeing tender rejections stabilizing. There was quite a big fall from July 20th to August 5th, but now we're seeing that fall less quickly. Volumes are stabilizing as well and beginning to pick up a bit. Spot rates year to date have fallen since that earlier peak, but again are sort of stabilizing. But I think the interesting thing here is that contract rates are continuing to rise and that gap is narrowing. So you can see on our rates.usa chart, where you look at a baseline, there's been a larger gap between spot and contract where, spot has been significantly higher than contract. Then there was a bit of a dip as we saw rates fall, and now it's stabilizing again where that gap is a little bit less. If you compare spot to intermodal rates, our NTI to VCRPM 1, those contract rates do not include fuel. You see about a 66-cent gap right there between the spot and the contract. However, those spot rates are all in, those contract rates are line haul. You can estimate that fuel right now, based on the DOE being about $5.45, if I recall, that most fuel surcharges are paying about 70 cents per mile. So again, we're really seeing that gap between spot and contract close, where those rates are very closely mirroring each other. That will be something that we're continuing to watch as both shippers, brokers, and carriers try to right size their spot to contract mix in this changing market, and how that will change throughout the rest of this year and peak. I do anticipate spot rates will go back up a bit, but it is nice to see those contract rates rising. I also want to talk a little bit about intermodal as a whole. If you look at overall in our intermodal dashboard, you can see the truckload to intermodal rate comparison on one side, and then the second side of this chart you can see intermodal volume trends. So you can see that intermodal rates have not risen nearly as much as contract or spot truckload rates, and intermodal volumes are continuing to rise and pick up. And so I wanted to dig into a little bit more on that savings index and show, compared to the prior few years, what a massive savings intermodal is offering in current market as truck rates have gone up and intermodal rates have remained relatively steady with minimal increases. So you can see that huge gap with prior years compared to that blue line being current year in our own intermodal savings index, and how much higher it is than it has been. In our intermodal dashboard, you can look at mode optimization. So I picked some of the top lanes showing the most savings currently, and it really is in line with what we've been saying, with a lot of those East Coast lanes leading the way in the savings, specifically out of Atlanta and out of that Harrisburg, Pennsylvania market. We know PA has been hard to find truckload capacity. So digging into the details there, when you look at Atlanta outbound in our savings index, specifically on these lanes, you can see Atlanta to Chicago, Atlanta to Joliet, similar lanes, following a similar pattern to each other. And then you can also see Atlanta to Elizabeth, New Jersey is that orange lane, and you can see how the savings really have continued to go up as we tick towards the most recent dates. If you dig in and you go to just the last 3 months and look at that a little bit more closely, it doesn't look like quite as a significant jump, but really in all cases trending up. That intermodal savings is continuing to rise. When you look at the outbound Harrisburg lanes, those top saving lanes, which are Harrisburg to Atlanta, Harrisburg to Ontario, California, and Harrisburg to Los Angeles, so those two similar to each other. You can see the Harrisburg to Atlanta in blue, and then the two Harrisburg to California lanes in orange, and show those savings pretty significantly. When you look at the intermodal dashboard, you can actually click on those specific lanes, and all of the charts update to what this next graphic is, which shows the truckload versus intermodal rate trends on those specific lanes, as well as the intermodal volume trends. So looking at that Harrisburg lane going specifically to Atlanta, you can really see the volatility in the truck spot rates. You can see the intermodal rates with a minimum rise, and then the van contract rates with a really pretty significant rise. So you can see up about 42% on average for the van truckload rates, up about 26% for the van contract rates, and up significantly less at 16% for the intermodal. So that is such a good reason to consider mode conversion, take advantage of those savings, and understand where that helps, even in a backhaul lane, like what would typically be PA to Chicago at a length of haul that's not transcon. And you can also see those intermodal volume mixes where they are picking up a bit of share in this lane. So good insights to continue watching what's happening in the truckload market and how that can push to further intermodal conversion and getting more volume off the roads and on the rails, and what that will eventually do to contract intermodal rates. We'll be watching those to see if an increase comes out. We had said previously that we thought we might expect up to 8% increase in intermodal contract rates. I would posit that in the wake of the current merger situation, that the two railroads involved in the merger aren't going to really want to make waves or give shippers or any of their customers any reason to oppose the merger. So they might sit quiet and hold on rate increases, which then means the other railroads will likely do the same so they don't lose market share. But we will be watching to see.
Doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Talk about the Knight-Swift earnings. We have Todd Maiden, FreightWaves reporter, who covered Knight-Swift's earnings report. Todd, tell us, what is your general takeaway from this earnings report for KNX?
Really nice beat, 23% earnings better than expected. But, it's really confirmation to JB Hunt's results last week that the cycle has indeed inflected. JB Hunt had some idiosyncratic things going on, taking market share, cost cleanup, that I think some investors were kind of speculative of, can we extrapolate that across all carriers and across the market in general? And Knight certainly delivered last night. And the best part, their commentary was even better, and the outlook for the rest of the year. Momentum built throughout the quarter, tender rejections, spot rates, contract rates, all up and to the right, April to June. Their tender rejection rate was twice the market average, which speaks to the strength of a large, well-capitalized carrier. And then all of the strength came in truckload. You look at across less than truckload, logistics, intermodal, mixed results there, but truckload drove it all. And the best part is the reason that more is on the come, as far as earnings are concerned, it was achieved through rate. You're talking about better utilization and cost takeouts, and just starting to see contractual bids that were inked earlier in the year bleed through to results. So as that continues to gain momentum and more of the book is repriced and actually implemented, all that's going to drop to the bottom line. There's not a cost offset to it. So really positive, and I think more so than the result is the forward-looking guidance.
Todd, I think my takeaway, if they're at 30+% rejection rates in their route, what freight is being tendered, we study the market. Obviously, Sonar is the place where people tender rejection data, or OTRI and STRI indexes are the benchmarks of the industry. The obvious answer to a 30% rejection rate is that rate is a lot of rate momentum that is yet to come, because it means that they're likely underpricing or have these old contract rates that are underpriced to market conditions. If they're able to achieve those kind of rejection rates, that means a lot of rate increase is coming. I mean, that's clearly the takeaway here.
Well, and they spoke to that a bit. I can't remember the quote exactly, but I remember saying that they finally saw contract rate momentum starting to really pick up in some of those no bid awards at the increased rates in the back half of June, and are already seeing it in July, I believe, as well.
Yeah, so and they received some pushback from analysts on the call. Rate per loaded mile only came in 6% higher year over year, but there's a lot of nuance to that. One, they said the bulk of what was implemented in the quarter was inked in January, February, when the supply side didn't look anything like this. They're seeing a ton of mini bids. They're also conducting a bunch of rate reviews on contracts that aren't scheduled to roll until later in the year. And they're going to bring those up to snuff, to closer to market level sooner than the annual bid negotiation. But then you also had, 28% of their fleet's dedicated. So you have some of that's just tied to regular, producer price index escalators. So that was a little bit of a drag, but right now they're getting double-digit contract rate increases across the board, and their spot market exposure, if you're an investor, their spot market exposure is gapped up another 5%. It's up to 15% now. So they have that optionality to play the market through the rest of the year.
Well, I think one of the things that you see
closely managing tender acceptance on their contract very clearly.
If you're rejecting 30% and you're managing, as Julie says, the tender acceptance numbers, there are 30% rejections, you can easily take freight from the spot market, which I think is probably, Todd, the takeaway another takeaway is that they are shifting some of the capacity, perhaps from the U.S. Express operation, where it wasn't as tightly managed as the core Knight-Swift business was prior to their ownership in it, and therefore they're able to benefit from some of the spot market inflection when there's such a wide delta between spot and contract.
And then I also wonder, and I don't know how the interplay is now, I don't know how it's changed, but in
terms of disclosure, just to be fair,
yes.
you ran U.S. Express's dedicated operations, or you were a part of different operations inside of U.S. Express. Of course, our family office still owns some equity in U.S. Express itself. So, but in terms of operations, you were saying?
Yeah, and so I don't know how much of this they do at this point, but my intuition and what I would infer from the numbers is that a lot of that higher paying spot freight that they're able to pull on to the asset-based trucks is coming from logistics because their logistics load count was down. Revenue per load was up, but their load count was down, and they still had a relatively compressed margin in that brokerage group. So I wonder if some of the high-paying freight that their logistics group books goes on some of the assets to continue
So that spot market, last minute. Spot
to
market
continue to drive that rate per mile up with some of that spot freight.
Yeah, I mean they don't talk about it specifically, but you're right. There's some cherry picking there. I mean, I know it occurs on the asset-based carriers that also have brokerage models. Absolutely, in a market like this, and like you said, 30% tender rejection rate. Those loads that come across their broker board, and they've already transitioned equipment into spot. They're absolutely jumping on those. Yeah, and I think. On the brokerage side, 350 bips of gross margin compression, but that was really in line with the rest of the market. And they've also had the added headwind. I don't think they were as far along as like a JB Hunt in their carrier vetting protocols, even though they're still within the group of brokers that's considered industry leading and kind of at the forefront of, getting out the bad actors over the last year plus. So I think they had a little bit of work to do, and that's why that load count was off a little bit.
So we talked a little bit just now about brokerage, talked a lot about their truckload. What about LTL? We saw shipments down. Tell us more about their LTL report.
Yeah, tonnage was down, tonnage was up 4%, but shipments were down 4%. So the delta all came on an 8% increase in weight per shipment. So some headwinds there. They're being more selective on their freight mix, which is positive for price, positive for margin. And they also enacted some temporary embargoes at certain facilities, and that was to maintain service levels. So the activity's out there, and as that freight, that heavier stuff that was lost to truckload through the downturn to a depressed truckload spot market, that's starting to bleed back into LTL networks. So I don't think we can take a ton out of their volume trends, but what I will say is when you look at the other public carriers, your ODs, XPO, Saia, ArcBest, and you kind of aggregate their tonnage trends on a 2-year stack comparison, which takes out the volatility of what their prior year comps were, they all inflected positively in May and should have done further so in June. And we'll get June results next week when they all report. So LTL for Knight-Swift's a little bit more stable. They're still in the early innings of their LTL journey. You're talking basically 180 terminals added through acquisition and organic additions, buying from Yellow Corp's defunct estate over the past 5 years, but really a lot of activity in the last 2 years. And it takes 6 to 12 months to get a terminal to break even, and another 1 to 3 years to get it to where it's actually comping to what the rest of your network looks like on a margin comparison. So their story's a little bit of an outlier, but I think the trends are firming. Stable to firming is kind of how I'd quantify their LTL trends. But the broader industry is doing better. And we're talking multiple quarters. Nothing speaks to the health of the industry more than multiple quarters of mid-single-digit contractual rate increases year over year. So high moats, high defensibility in LTL, and nothing's changed.
So Todd, the intermodal business for Knight-Swift certainly is not as bullish. At least the read on that is not as strong as what we got with JB Hunt and even the intermodal volume. Is there some takeaway that you have on some of the intermodal? Look, there's been some improvements, but certainly not what we saw with some of the other. JB Hunt blew out their earnings largely because of intermodal. What is really Knight-Swift's challenges with their intermodal business?
So, yeah, some of that was comp driven. Between TL and the onboarding of LTL, I think it's more of a complementary service. It's not that big, not that impactful. I mean, you're talking about maybe a 5% revenue contributor, something that's been a drag on earnings. So, as far as focus, intensity, what requires CapEx dollars and attention, it's all going to TL and LTL. So I think it's, whereas JB Hunt, I mean, as you know, I mean, they're leading intermodal first, dedicated first. There's kind of a race there for JB Hunt between which one will end up being bigger for them, dedicated or intermodal. But so I think it's just, their focus, it's a complementary service. They have some tailwinds. They control most of their dray capacity. They control most of the drivers. So there are some tailwinds. And, as freight continues to convert to rail, they're certainly going to be able to participate in that, but they're just not, one of the top players at this point to where it's going to jump out off the page and drive numbers.
Yeah, and while it was barely profitable,
Right.
I mean, they did see the volume grow in that segment, and it was huge improvement in their OR over prior quarters for that segment. So
Yeah, I mean, look, it's interesting because we've talked about this before. Is that logistics businesses inside of an asset-based business, JB Hunt's logistics business is not remarkable. I mean, it's sort of average. It certainly isn't as good as some of the pure play logistics operations. You could argue that for Knight-Swift, it's the same thing, kind of an average operator in logistics. Logistics is secondary to the truck. I think at the end of the day, if you've studied asset-based models, and I think in JB Hunt's, what Josh said is that he works ultimately for intermodal. That's what pays his paycheck, not the trucking business. The trucking business for Knight-Swift is certainly the flagship.
right.
The trucking business for JB Hunt is sort of the derivative of really empowering
Have to have
your
that
overall
service
business.
to be able to
It's a
provide
single
all of those
source.
things to your customer.
And I think that's what my read is that ultimately Knight-Swift has the highest exposure, highest set of solutions in the over-the-road trucking business, and is a better barometer for the overall market than JB Hunt is, because JB Hunt is so well positioned for their business. That's why it's the best operator to own if you're going to own one, simply because it has such great exposure from all cycles. Knight-Swift is a much better signal to the overall freight market, and it tells us, my read on this, Todd, is that we're early. And I think that is what I would take away, is that this cycle is going to continue. 600 plus trucks that are down in terms of seated trucks. They're talking about how tight the driver market is, which does tell us that we're going to be here for a while.
All right, Todd, final question. What has been the market reaction to their release last night so far? I haven't been able to look much at it.
A little down.
Investors maybe entering price for perfection. So I don't think everybody got the third quarter guide. There was also a little bit of pushback on why is it taking so long for your rate per mile to inflect, which we talked about earlier. But here's the thing I would look at. All right, so the guide came in 71 cents in the third quarter. 71 to 77 cents, so 4% higher than the consensus estimate. And that's on numbers that continue to gap higher through the period. So I think there's a lot of conservatism in the guidance they provide. Their Q2 actual result beat their guidance by 34%. So I'm not saying there's 34% upside to the number they provided last night, but I think there certainly is some. And the thing is, everything, like you've talked about, is in front of them on the rate side. And I think the most important thing to take away from that drops through to the bottom line. There's no cost offset. They're not even at the point yet in this driver market where they need to raise wages across the board. They'll do it in select markets, but they're going to use better utilization to get more driving time and more loaded miles for their drivers, which will raise their pay. So there's really no cost offset. They have quarters here ahead of them where if we stay kind of where we are, get that seasonal improvement in the back half, the numbers are really going to inflect nicely. So I think everybody was a little concerned that the guide wasn't stronger for next quarter.
I think, like you said, everyone's expecting perfection. And I think if you've been around this industry, we can't have nice things. That's why everyone's very conservative. I also think there's been some softening in July. We've been talking about it all last couple of weeks, just the overall market. We're not seeing the momentum continue. And that's probably, made management a little bit more conservative just to make sure that the momentum holds.
Yep.
Does tell you have a lot of hope over the next couple of quarters. Well, appreciate it, Todd. Great report. Always great to hear your thoughts. Todd worked on Wall Street. He did the opposite of Rachel Premack, Seth, and JP. He went from Wall Street to FreightWaves. But he's always a great someone to have on air. We'll be right back.
You ever see yourself short on trailers right when demand picks up? Our friends at Premier Trailer Leasing can help you stay ready. With more than 70,000 trailers and over 40,000, trailers with 40 locations nationwide, Premier gives businesses flexible access to dry vans, reefers, flatbeds, and chassis when plans change. They're known for transparent pricing, quality equipment, and 24/7 in-house road care support. So you can get more than just trailers. You can get a partner that helps with your operation and keeping it moving. Visit them right now at premiertrailerleasing.com to get set up before your next big surge.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference, it's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else, the connections that change the trajectory of your business, the relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. It is earnings season. We're on a roll. Not just the railroads. We have OEM earnings. We've got big transport earnings. And the person to break it down for us is Chris Versace. He is the portfolio manager at the Street Pro. He's the chief investment officer at Tematica. Chris, welcome to FreightWaves Today. By the way,
nice to be back,
guest.
fellas.
So welcome back.
Thank you. Thanks for having me back.
So let's talk earnings. UPS has reported their stock sold off. I think some of it was guidance. Obviously, the Amazon story has been overhanging their stock. What's your general sense of UPS right now?
Well, UPS to me has been kind of a tough one to contemplate owning as an investor. Having said that, I get packages all the time, but from an investor, we have to always assess a few things. One is the competitive landscape. Clearly, Amazon, not only on the retail side, but the flex that it announced earlier this year by moving into business freight and delivery, that's raised a lot of questions. And when we talked about UPS's earnings, they didn't really guide the back half of the year higher for the domestic business, which is kind of counterintuitive if you think about it, given what we're seeing in terms of the consumer being resilient, the lead up to the holiday shopping season, and just overall demand for freight. So it's a bit of a puzzle to me.
And it's just, I guess, there's so much. It's hard right now knowing all the different impacts. The regulatory environment, container flows are really robust compared to where they've been. I think our data, our channels checks say that the consumer is doing quite well. At least the freight part of the consumer supply chain is doing quite well. But it looks like this Amazon story with UPS, it feels like that's the biggest factor. Chris, am I reading that incorrectly?
Yeah, I think that's right. I mean, you have to remember, too, that UPS has kind of been a restructuring story. And, a lot of folks are still waiting for the payoff in that, to the extent that it is taking longer than expected, or these other competitive challenges that we're talking about are going to make it even longer to show, progress that people are hoping to see. I think that's really what's weighing on the shares and really the company's business. To me, it's very much a wait and see. But at the same time, given the seasonal dynamics, especially in the consumer freight delivery business or consumer package delivery business, to the extent that Amazon is taking more share out of UPS, flip it around, UPS is not exactly guiding for a much stronger second half of the year compared to the first half. That's a little worrisome to me.
Yeah, it is. It is interesting. We do a lot of channel checks, not only on the show, but certainly on the show. The freight market, at least the channel checks that we've gotten, the interviews have all talked about how robust it is. Feels like a UPS story. I think you talked about the fact that it is a sort of, I wouldn't call it a turnaround, but a restructuring post-Amazon, as well as when Carol has come in and divested a lot of their businesses, Coyote, which we'll hear from RXO in a couple of weeks about how they're performing. I guess that is next week. Oh my gosh, I can't believe we're the last week of July.
We have a guest from RXO tomorrow too, but
we have a lot of guests.
But yeah, I agree, Chris, with what you said regarding, I think they tried to do damage control by saying if you ignore Amazon and the volume we intentionally made available to the market, we actually grew our volume in the second quarter. But then just the third quarter outlook felt so weak that it felt like a
was that weakness just by Wall Street's expectations because everybody else had been so robust, Chris, or was this a weakness that they actually felt across their network?
I think it's a little bit of both, and the point about blah, 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 but, the reality is that, you can talk about underlying strength, but relative to what Wall Street is looking for, it's the overall numbers that really matter most. So if UPS is saying, on an adjusted basis, if we strip this out, strip that out, we would have done this. That's not really what happened. And I think that's kind of trying to, as some might say, put lipstick on a pig, not exactly what you want to hear. But again, the outlook wasn't quite as robust as Wall Street was looking for. I will say that a lot of what we're seeing in the larger stock market today is companies that are even putting up good numbers, may be falling short of some of those whisper expectations that the market might have had given the run-up in the overall stock market from earlier this year, certainly off the April lows. And I think to the extent that companies are not able to deliver not only a beat for the quarter they're reporting, but a raise, that is weighing on shares. And I think we're seeing some of that play out in the shares of UPS.
Well, the market got so elevated, and even the transportation, the truckers have one of the best up until really the last month or so, best performing sector, one of the best performing sectors, truckers specifically, which we haven't been able to say that in a long time, just how strong things are.
Well, even ArcBest's, after their report of the OR that we talked about at 70, their stock fell.
You mean Old Dominion?
Oh, I'm sorry, Old Dominion.
Although we are going to talk about ArcBest in a second. Old Dominion, Chris, 70 OR, everyone in transportation and trucking looks good. Old Dominion looks best. They did look best.
Well, so I have to be honest, I haven't, dug deep into that report. What I can say is this, is that we are seeing demand, from the rails, be very strong. We are seeing tight capacity utilization for the truck fleets, and there are some very specific reasons for that, both demand side and supply side. But at the same time, we're also seeing and this is something that we touched on the last time I was on, we are seeing OEMs and owner-operators open up their wallets for replacing, heavy trucks. You take a look at what PACCAR said the other day, 105,000 heavy trucks in the first half of the year, 145,000 expected for the second half of the year. That's a big jump. So I do think that while we are talking about areas of, some call it frustration, other areas where companies may not be achieving what was expected. There are others, and I would put PACCAR in this camp, that the outlook continues to look very favorable into the back half of the year.
So, Chris, I want to bring my dad in. He's bought more trucks than all of us combined. PACCAR's, Kenworth, Peterbilt is really, the portfolio there. What in this market, whom do you think of the OEMs that has the best product lineup? Is PACCAR have the right product lineup for this market, or do you think that Daimler or Volvo are better positioned, or International?
Well, I think they're all positioned pretty well for this type of market. But, PACCAR has been pretty innovative in a lot of their products, especially having Peterbilt, which a lot of truckers think is probably one of the better driver-type trucks in the market. Kenworth has been pretty innovative in a lot of their fuel economy.
Yeah.
But PACCAR is a very strong company. They bring a lot to the industry, and they've helped redefine this industry quite a bit over the last probably 30, 40 years. That doesn't mean Freightliner and Volvo are very strong too, though.
You mean that they are very?
They are very strong.
Chris, any thoughts on that?
I'm just going to say what he said, pretty much.
Well, our audience, especially on X, has an opinion on what they call plastic trucks. And they're really knocking the Freightliner trucks because they like the whole, they like to go old, the old Peterbilt is the deal. Yeah. I think Mack has got the best looking truck on the road, but nobody asked my opinion on which truck you're doing.
And yet nobody's mentioning a name from the past known as Western Star.
Yeah, right. Yeah. So it is interesting just how all of the OEMs are coming in with real strong guides. How much of this, Chris, is the pre-buy, or how much of it is are you getting a sense that this is replacement or expansion?
I think it's a little bit of both. Obviously, the pre-buy is something that we're going to be talking about over the next several months. And in PACCAR, I thought had an interesting comment about the way they're going to attempt to try and smooth out the pre-build into 2027. We'll see how that happens. But at the same time, if we listen to rising capex levels from some of the logistic companies, Werner, for example, TFI, it speaks to them, replacing existing capacity potentially for ones that are more fuel efficient and obviously ahead of that mandate. So again, I think it's a little bit of both.
So I read that as well, and I thought that was a really interesting comment, the way that they talked about, to dig into the EPA mandate a little bit more, that they're going to continue selling their current engines through 2026 and then gradually phase in the compliant 2027 engines because they don't want to have that pre-order cliff.
Are they allowed to sell, if they have a 26 engine in stock, are they allowed to sell it into 27, or do they have to actually have the 27 engines when that goes into effect?
Yeah, my understanding is that the cutoff point is when or historically it's been when they introduce the new model year. And I think PACCAR tends to have, in particular PACCAR, tends to have an annual event where they, reveal the new model. And I think that's when it is. The question is, is that early in the first quarter, late in the first quarter, or do they push it even to a little bit later in order to accommodate, that maintaining the 2026 engine for a little further?
Now, what are you expecting beyond, obviously, the emissions? Any cool technology that the OEMs are talking about, or is this going to be a year that the drivers themselves are going to be a little disappointed in their product rollout?
I think, primarily the drivers from a industry order, industry delivery mechanism is going to be more influenced by that EPA mandate than anything else. I'm sure we'll see some incremental new features, but I haven't seen anything that is jumping out at me that says, wow, this is
cool. This is the new toy, right?
Right. That this is cool. This is the must-have. This is what's going to, if this was the iPhone, we'd be talking about, what's going to drive the upgrade cycle. I haven't seen anything out there that jumps at me to that degree.
Although, Chris, much like the OEMs, Apple's gotten criticized because their release feels like much of the same. In fact, Steve Jobs' daughter has a great tweet a couple of years ago where she's like, this is exactly, like all the features are the same. Dad, when you look at OEMs rolling out things, obviously you got the new engines, but is there anything that you got really excited about? Like, what was that like when they would do new features? What were the things that you were looking for? Was it more fuel economy? Obviously is important, total cost of ownership. Was there anything that you're like, whoa, that would be amazing?
Well, total cost of ownership is probably the number one.
Yeah.
Because you have to be able to afford it. Number two is, when you've got a truck that gets better fuel economy, or a truck that basically has a better ride for the driver, better safety. I mean, there's a blend of things that you're looking for when you buy a truck.
Very different than consumer buy cars. I'm a pilot, and if you've looked at a Cessna 172 from 1960, it looks the same. And so the joke is Cessna is going to release the same thing. If they upgrade the upholstery in the airplane, that's an innovation for Textron.
Sorry.
Go ahead, Chris.
I was going to say, it's all about those creature comforts. The one thing I didn't hear your dad mention is kind of the setup for the driver in the back. I think to the extent that there can be some incremental room or other creature comforts, I think that's a plus.
Yeah, for sure.
So did anything else stand out in PACCAR's earnings to you, Chris, that we haven't touched on?
Just the fact that production levels are poised to go higher, that the build level, if you look at it, the slots are really filling up for the balance of this year. And I think that bodes well for some incremental pricing, which in my opinion, when we tie it together with rising volumes and better pricing, that's great for margins in the back half of the year. And the reason I talk about this is we took our price target up on PACCAR shares because of that incremental profit expectation in the back half of the year. So I am very bullish on those shares over the next few quarters.
Chris, Dirk Leathers, the CEO of Werner, talked about how tight the driver market is, how difficult it is to find qualified drivers that can meet the standards. And that's really putting a cap on capacity growth. And he thinks that we're in the third inning. Obviously, there's 9 of those, which I think is promising for this cycle. Dad, when you're hiring drivers, when you have a tight market, how much is new truck important to attract drivers? And do the new drivers get the new trucks, or does it go to the more veteran drivers to retain them?
Well, usually your veteran drivers get the new trucks first. And new drivers come in, they get the older trucks. But you've got to have a fleet that's relatively new anyway. We try to keep our average age below two years.
Yeah.
Which basically meant you didn't have hardly anything over 4 years old. But at the same time, drivers always like getting the new equipment, especially a lot of the new technologies that were coming out.
Yeah, for sure.
Made their jobs a lot easier, a lot more comfortable in the process.
Chris, any closing thoughts on earnings, TFI's earnings, Old Dominion, ArcBest?
So many, yeah.
I mean, it is, the problem of this week is it just one after another after another.
Well, that's a problem for some. For me, that's great because you get to sit back, kind of connect the dots and piece it all together and that helps kind of improve the outlook for the back half of the year, greater clarity, in other words. So the one thing I would say, just to touch on, is that as long as the industry has tight capacity, and we do see some incremental demand, I think that's going to allow for more favorable pricing. And if you just take my comments for PACCAR and follow it through, tight capacity, demand, pricing, better margins, better earnings, potentially in the second half of the year.
Well, it feels like we're really in the third inning. Companies can improve. We'll see how good Old Dominion can make that 70. Appreciate Chris. Thanks for joining us. Always great to get an update as we have earnings.
If you own or lease trailers, you may have a coverage gap you don't even realize exists. Centerline offers customized trailer insurance solutions for freight brokers and transportation companies, including liability and physical damage protection, with limits up to $1 million. With flexible pricing, customizable coverage options, and a dedicated claims team, Centerline delivers protection built specifically for the transportation industry. Visit centerlinepc.com to learn more.
The world world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
We have a great treat. This is earnings season. This is an opportunity to talk to the folks that are actually moving the freight. And our first guest, we have Seth Runser. He is the president and CEO of ArcBest, one of the most storied LTL carriers, if not overall transportation carriers, has been around for a long time, for decades upon decades. Well pre-regulation, is now one of the few survivors of pre-deregulation that's still around. Seth, welcome to FreightWaves today.
Yeah, thanks for having me, Craig. I appreciate you being on. Sorry about those technical issues. I think we got them resolved.
It gave us the opportunity for Julie and I to catch up on, by the way, technical issues are a part of putting on FreightWaves today.
Live TV is, yeah.
Live TV has its own set of things, so you're certainly excused on that. But let's talk about an area that you don't need an excuse, is your earnings. You guys are absolutely rocking and rolling. How does it feel to be CEO of a business in this climate when, you guys are putting up some really impressive numbers compared to historically how this market's been?
Yeah, it feels great. So you think about our performance normally sequentially from the first quarter to the second quarter. We improve about 350 basis points. That's really just the seasonality. The first quarter is always kind of the weakest. And we improved about 650 basis points within our asset-based operation. And then asset light saw a meaningful step up as well. So really proud of the team for them executing. It's a combination of factors when you think about everything that's going on with supply, demand. We're starting to see some early signs there. And then just what we've seen in the marketplace as customers are navigating all the disruption and complexity, they're really turning to those trusted providers that have 103 years of experience like us. So it's been a great feeling to get out there with earnings this week and spend time with our people talking through what we were able to accomplish together in the second quarter.
So Seth, let's talk about demand. You talked about demand. It feels like it's recovering. You're seeing signs of recovery. That is a I would say in many ways, a lot of folks have not come in with conviction about demand. I think everyone recognizes that this is a capacity-led recovery. I don't think we dispute that. I don't think you dispute that at all. But let's talk a little bit the demand side. That's an intriguing perspective that's different than what a lot of people believe is happening.
Yeah, I think demand, it's kind of in the early stages, I would say. We're not anywhere near like a mid-cycle or even an upcycle. It's really supply driven, like you said. That's really what's driving a lot of the things. So customers are trying to navigate as truckload capacity tightens. They're looking to logistics companies like ArcBest to help them navigate all those different disruptions. And we saw that come through in results, which was great. But we are seeing some early signs. You know, it's good to see that PMI has been in expansion territory for the past 5 to 6 months after 4 years of it being depressed. But what really encourages me is our pipeline continues to be strong. We continue to have great conversations with customers. I feel like as that truckload capacity tightens, it kind of turns the light on, hey, we want to partner with companies we know, like, and trust that can actually navigate this with us. And that's what's been so impactful throughout the quarters. Our pipeline's only strengthened, but I wouldn't say it's robust demand yet. I think it is supply driven, like you said, but we are kind of seeing some early signs, especially as we've seen some of this more truckload rated freight kind of come into LTL, very, very small amount, but we're starting to see those early signs of those plus 10,000 pound shipments making their way back into our network, and they just work better in an LTL environment. So I'd say we're early stages, but yeah, definitely supply is what's driving a lot of the results you're seeing out of all the carriers who have announced this week.
Seth, we've been watching the LTL. We know that LTL recovers a little bit later than truckload typically does. You need tightness in the truckload market because shippers take advantage of direct point-to-points not being handled through a dock network when they can consolidate. And then when the freight market tightens, a lot of that LTL volume, as well as in the early parts of the cycle, they're building out larger truckloads because of larger volume segments. We only recently, CAS's shipment index, which is more weighted to LTL than it is truckload, is reflecting the fact exactly what you're seeing. Do we think that we're well past the point where this market truly is recovering from a demand side?
Yeah, I think we're still in the early stages of the market recovering from the demand side. There's still just, if you look at historical averages, and like you said, we've been around a long time, so we've seen a lot of cycles. When you look at a lot of the kind of subsectors within that, there's still weakness in a lot of different places, but there's also bright spots in a lot of places. I talked about it on our earnings call the other day, the data center build out, we're seeing a lot of demand there. Customers who are shipping, ATVs, we're seeing a lot of demand there. But there's other areas like apparel that we're not seeing demand. So just kind of, it's uneven, I would say. So I think as demand strengthens, that's going to ultimately improve results for everybody. But the way we've built this company and transformed over the last 10 years is we're an integrated logistics company. So we can go to market and we try to say yes to our customers, regardless if they're looking to move truckload to LTL or go to a managed solutions or they need a more premium service. That's really what we've designed this company to do, is say yes to our customers no matter what's going on in the supply or demand environment.
Yeah, congratulations on a near 90 OR on your asset portion of your business. But I do want to talk a little bit more about that asset light part that you just alluded to. So 28% revenue increase, 15% increase in daily shipments, revenue per shipment up 11 to 12%. So it seems like everything is heading in the right market. Are you feeling the capacity squeeze on the other side of that? How has sourcing been?
Yeah, I think sourcing has been good. When you have the history that we have, we build long-term partnerships with a lot of our partner carriers, which is great. So I'm really proud of the team and the execution. If you look at what happened in asset light in the second quarter, we produced a little bit over $6 million in operating income, and when you compare that to all of 2025, we only made $1.5 million. So that shows you the progress on all the initiatives that we outlined at our Investor Day last September in New York City. it really comes around to profitable growth, making sure we're growing with the right customers, making sure we're efficient with our resources, and make sure we're partnering with companies that trust us and we trust them to haul our customers' freight. And that's been impactful. So with all the partnerships we haven't really felt the capacity crunch too much because, like I said, the way we've built this company is find a way to say yes. And we have a lot of different partnerships which allow us to do that.
So certainly a culture of trust across all of the business units. Would you talk a little bit about the decision to have MoLo, Panther, those other brands move under the ArcBest name?
Yeah. We went to market as an integrated logistics company back in 2017, and we've transformed. And we've done some of that through M&A, some of that through organic investments, and that really came from customer feedback. They were telling us, hey, we don't just have LTL. We have truckload, we have managed, we have expedite, we have all these different solutions. So that really is what we started to do. So the announcement a few weeks ago where we consolidated the brands underneath ArcBest, that was really about simplifying our brand strategy to say, okay, we are ArcBest, that integrated logistics company, and we have solutions underneath, whether it be truckload brokerage, LTL brokerage, any of those areas. That's really what it was about, was simplification and going to market as one ArcBest. And we really heard a lot of that from our customers, from our employees that said, hey, why do we have all these sub-brands? So this is really the next step in that evolution to make it simpler and easier for our customers to access all of the solutions that we have. The feedback I've heard from customers and employees alike has been very positive, kind of this long overdue type scenario. So I've been really encouraged by everything I've heard from the team and from our customers since the announcement came out.
So you guys have been around since 1923. You've survived multiple world wars. You're coming out of the 1920 pandemic. You guys have had a storied history. One of the things that we've talked about when you guys made the announcements on the MoLo and Panther brand consolidation, we'll call it, was the fact that the culture of ArcBest is this legacy, very structured organization, is one of the reasons you're so successful. And we're big fans of history and your history in particular. As a pre-deregulation carrier, MoLo had a very different culture. It was the Chicago Central, the Silvers, Andrew Silver, sort of a freight bro, if he from Central Casting. When that announcement was made years ago, from where I stood, it seemed like a very strange, or at least a counterculture to the typical ArcBest culture that we know. What is that part of the reason to rebrand, is to change the way that business operates, or what has that been like in terms of the overall integration into the overall ArcBest organization?
Yeah, so I'll just take a step back to a few years before the MoLo integration. So before we even announced the move. So really what we were hearing from our customers was, hey, we really trust you for LTL. You're doing a great job with Panther and Premium Expedite, but your truckload offering really wasn't as strong as it needed to be. So we had our own truckload brokerage at the time. It was probably $300 to $400 million, a lot of transactional type customers. But what MoLo brought and what was really attractive about them was, A, it filled a strategic gap for us because our customers were asking for truckload services, and B, what they built was really a service-first mentality, and that's what ArcBest is known for, a premium experience for our customers, and that's what made it so attractive to us. So we got to fill a strategic gap. They believed in being customer-led and servicing customers with excellence, and it just really fit perfectly. So as we've integrated, really what it's done is it's expanded the capabilities, because all of our customers, we have about 30,000 active customers, they all have truckload needs. It's their biggest spend. So by having a really strong offering in what we purchased with MoLo, it only strengthens those relationships with customers. And we're kind of past the integration phase, and I feel great about the progress we've made, and the team's done an excellent job. And I'm really excited that we hired Mac Pinkerton to come in and lead our asset light operation. He led CHR's NAST product, and that's the largest broker in the United States. So he's really helping transform us into what we can ultimately be. And I feel like we're in the second or third inning. We got a long way to go to get to where we ultimately want to be.
Well, that alumni network, the C.H. Robinson Alumni Network, there's no denying that it is persistent across this industry. They particularly out of Chicago, that Chicago central office, the old American Backhauler's office, has written a lot of the success of Chicago, Molo being a Chicago-based broker. I would argue third or fourth generation, Julie, in terms of brokerage. If you sort of think of the evolution of freight brokers, sort of the American backhaulers, U.S. Express was a big American backhauler, C.H. Robinson Central. This evolution, I think I would argue that Molo was sort of the fourth generation, maybe.
So what's
Chicago.
the third?
Well, you have Echo. Echo is sort of that third. You Command, you could argue Command.
So it goes from backhaulers to the original CH, to then some of those expansions.
Command,
maybe even Coyote, that
Echo,
group.
Coyote would be maybe fourth, and now we're third or fourth. But you're in this sort of fifth generation, and really Chicago has become such a high concentration of freight brokers, its own culture. Like when you describe to somebody in freight about the Chicago freight floor, everybody knows what we're talking about. What is going to change for you guys with Molo becoming an ArcBest? I'm sorry, I haven't had a lot of sleep this week, so if I fumble my words, it's. But what is the goal here in terms of what can customers expect that's going to change? Where are the investments going to be made?
Yeah, to me, it's not a matter of what's going to change. It's what's going to strengthen. And that's really what we're trying to do with this brand is we're trying to simplify our approach to the market, make it easier to access our solutions, and ultimately combine all the capabilities that we have as one ArcBest into what our customers can get access to. So we really focus on three strategic pillars: growth, efficiency, and innovation. And I feel like across each of those pillars, it's going to only strengthen with the brand. We don't have to spread out our advertising dollars among 4 different brands. We don't have to have different teams and different swag and all the different things, right? So ultimately, we want to be that integrated logistics company. And we feel like this is just the next step in the evolution of that strategy that we've been embarking on for over a decade. And this change is only going to strengthen and simplify and make us move faster in the market that we live in today.
Seth, if you're looking for a place to park advertising dollars, just call us up. Media's a tough environment. You think trucking's hard? Media sometimes can be a little harder. We'd love to talk about that. Panther 2, also a storied name. Not a legacy name in terms of the history of ArcBest, but a name that if you know Expedite, Panther 2 has been a market leader. You guys acquired it almost, I think, 17, 18 years ago.
Yep.
Is it going to be ArcBest Expedited? Like, what's the future of that business?
Yeah, it's also going to be ArcBest, and then underneath ArcBest, the logistics company, we describe it as premium logistics because they don't just do expedite. They do temperature validated, they do Department of Defense. It's kind of that premium logistics. Shipment cannot fail. So it's not just, hey, we're going to shut down a product line and we got to expedite that shipment. It's become so much more than that, and that's what makes me really proud. So I think what's going to happen is it's just going to continue to simplify exactly what I talked about. And what's been interesting is as we've had customer conversations around the branding change, they're like, well, we already thought Panther was ArcBest. And that's because it was. We're all one ArcBest team, right? So this just makes it a lot clearer to say, hey, ArcBest is a logistics company, can offer all these different services. What is your problem? What is your solution that you're trying to find? Because we'll find a way to say yes, whether that's truckload brokerage or managed solutions, any solution, we're able to say yes, because that's really what builds a trusted relationship over the long term and why we've stood the test of time.
So Seth, I don't think we can talk about premium logistics or integrated logistics offerings without talking about technology. So I think I recently read that you just launched a new product called ArcBest View. Can you tell us what that is, what it does, and why now is the right time to roll it out?
Yeah, I think about ArcBest View. It's something that we started building probably, I want to say 3 or 4 years ago. And really, when you think about our traditional customer platform, it was our website. It was arcb.com. Well, that was really built based off of an LTL environment. So because that's most of our history until we've made this transformation over the last decade. So what we heard from customers is they wanted a single source of the truth. They wanted to go to one place and find where they could track, book, quote, optimize their supply chain, get everything. And the old experience that we had, they had to go multiple places to navigate that. So we started building that platform side by side with customers from the very start. aren't. And that's what I think is impactful, is because you can build a great product, roll it out, and be like, hey, I hope everybody likes this. But if you build it side by side with partners we've had for 10, 20, 30 years, they're going to tell you what's going to work. And that's been very impactful for us. So really what that platform is, some people have described it as, hey, it's just a refresh of arcb.com. And it's not. It is a completely new digital platform that I think is differentiated in the marketplace, because now you can track, book, do all of those things across all modes. And that really is differentiating for us. We have about 2,500 active customers signed up for it so far, and the feedback has been really incredible. And that's what makes me feel so good. As we roll out further enhancements and continue to refine, we'll start getting more customers signed up for it. But a lot of customers are saying, wow, this is the best tool I've ever used. I have now complete supply chain visibility, which adds to that simplicity that we've been talking about, right? We wanted to simplify our customer-facing tools so they can navigate everything that's going on in their supply chain and not have to pick up the phone and call. They can self-serve, or they can pick up the phone and call. So I'm really proud of the team that built that, got it out there, and we'll continue to make enhancements as we move forward.
Seth, what are you guys doing in Arkansas that is enabling these old school legacy leaders? We covered J.B. Hunt extensively on the show. They're killing it on their intermodal business. You guys are, you completely transformed the business from an old school, sleepy, sort of regulated trucker into one of the most dynamic logistics companies. Is there something special specifically about Arkansas that enables, when I go through the list, you guys were number 12 in 1980, according to Transport Topics top 100. And I go through the list of those carriers that are still around. Most of those carriers, United, Parcel, Roadway, Consolidated Freightway, Yellow, McLean, Ryder, Truck, North American Van Line, Spectre, Red Ball, PIE, Allied, Smith's Transfer, Arkansas Best. You guys have been around. What is going on down there?
Yeah, well, we always, the way we position the company, like I said, we're customer led. And at the end of the day, if you listen to your customers and design solutions around them, that's what's going to stand the test of time at the end of the day, right? So, and we also, leaders before me, present leaders have built an amazing culture at our company. And that's really, if you look at Centurion companies that have been around more than 100 years, really the two things that stand out. It's a great culture, and it's the willingness and adaptability to change. And that's what we've done throughout all the time. So we're not thinking about next month or this quarter or next quarter. We're planning 3, 5, 10 years out. That's really the way we focus. And we always say internally, we have to focus on disrupting ourselves, because if we don't, someone else will. So I don't think we're that company that you described, the old school company. We're focused on technology. We're focused on AI, all the different things. But at the end of the day, it all comes back to, where does the customer find value? And if you stay close to your customers, you have great people, you're going to deliver some amazing things in the future.
I think it's an exception, Seth, to the rule. The reality is that you guys deserve a lot of credit for going through all of these iterations. We're in a new cycle. We're in a new market, it feels like. Matt, Dad, you've talked about the fact you've been in trucking since the 1960s. Mm-hmm. You talked about the fact that this freight recession and this market is completely different than any that you've experienced in your lifetime.
Right.
But you guys have made it through another cycle, Seth. There must be some formula for that has just enabled you to thrive so well, that I think is really intriguing, because so many of your other pre-regulation competitors just never made the transition.
Yeah, I agree. And a lot of that is just the paying attention to what's going on, focusing on what matters the most, and making the right decisions with integrity at the top of your mind. So I took over ABF and ran our LTL division in 2021 at the height of the pandemic. And I swear every time I picked up the phone, it was like a new thing was going on. The East Coast ran out of fuel because the pipeline got hacked, or you couldn't hire drivers, or you can't buy trucks anymore. The list goes on. And then a 4-year freight recession. So it's just, you have to know in the back of your head that disruption is the new normal. And if you prepare and build the company on a great foundation, and you're always focused on the future, good things will happen. And that's really what we've done with this company and what makes us so special.
Well, Seth, thank you so much. An institution.
Yeah.
I love talking to these. I'm a big fan of history. I'm building a history museum in Tennessee. We'd love to have.
Oh, great. I'll come down. Yeah.
be the largest indoor miniature transportation museum in the world. If the Smithsonian was doing transportation across all modes, it would be the Smithsonian. Real excited about that. We'll have to have you out there. Also, the International Transportation Hall of Fame, we're going to announce that. That will be there as well. Certainly someone along the tenure of ArcBest deserves that.
Yeah.
I mean, amazing. I love these businesses that have seen so much, Julie, so much history, and yet are talking about new technologies and doing it right.
Yeah, I mean, I think it just shows you that in business and in life, probably the most important skill you can have is adaptability.
And you got to survive. You got to be
like
there.
the coyote, right? That's why they're everywhere, because they're the most adaptable animals. Did you know that? I watch Wildcats with my son.
Except
they
are.
are.
In my yard.
No, they are. Like
they figured out how to do it. Anyways, well, Jeff, thank you so much for coming in to FreightWaves today. Would love to have you back, and best of luck in your journey as you continue to build out your technology. And we know that you've got a lot going on over there. And congratulations on a great earnings. And we look forward to reporting next quarter. We'd like to hope to have you back.
Doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Well, Aaron Graft, the CEO and founder of Triumph, one of the most important financial institutions to serve the trucking industry, particularly the brokerage industry, is with us today. First of all, Aaron, I got to say congratulations are in order. You guys absolutely killed this quarter. Congrats to the Triumph team and what you guys have been doing over there.
Thanks, Craig. Appreciate you having us. And after 4 years of running against the treadmill, it's kind of nice for it to reverse course and carry you along. I'd almost forgotten what that felt like.
We all have. It's been a miserable winter. We're out of winter. It's spring. I think the question that we've been asking, even talking about today, and our prior guests talked about it, is this question about how long does this cycle last? I know you don't have a crystal ball, but do you have a perspective on whether this cycle is going to go on for a while, or we're going to, we can't have nice things in trucking?
As a younger man in the last cycle in 2021, I made some bold predictions that were incredibly wrong. So I think one of the things when you get older, you should get a little wiser. And you more than anyone nailed this, and we're bold enough to step out and make the call on this cycle. What's different, and I wrote about it in the letter, and I'm not the only person to say this, you see this, but this is a supply-driven market, and I don't see an antidote to litigation, regulation, legislation, risk that's just going to allow capacity to flood in the way we saw it happen last time. So it feels more structural. We know it's a cyclical business, and who's to say when it would end, but it feels like it has more legs perhaps than what we've seen in the past.
Yeah, I think that certainly aligns with what we've been saying and thinking. The barriers to entry have certainly risen for those, so it's going to be significantly harder to add more capacity. But let's talk a little bit about state of freight demand right now, where you sit inside the data, what you're seeing overall. I know you said you don't want to talk about how long it's going to last, but can you give us some headline numbers on...
He's not going to be so bold to come in. He's a public CEO. He's got to be careful because his stock trades like a trucking stock versus a bank. It's a bank that seems to headline more with how the trucking, in tandem with the trucking operators than the banks do.
But I think there's probably some really good examples of how strong the market is right now and some indicators in your data to back that up.
Sure. I mean, here's something that surprised me and didn't surprise me. So the average invoice size in our factoring business, which is 15% or more of the entire market, is up 26%. Now, with all the headlines we heard, and to have seen that, what I would have expected is our customer count to constrict. But for all the reasons we've talked about, people being put out of service, brokers not tendering freight to carriers who don't meet heightened compliance standards, et cetera. And what we actually saw is we grew customers in the quarter by 4%, and we didn't see a lot of our long-term customers disappear. We certainly had some go inactive, and I can't tell you why they did or didn't go inactive. And so the first thing I would say to you, what the data says is the market is tighter. What I don't at least have the data to point you to is who exactly left to create the tightness. I know it happened. We saw less freight tendered to owner-operators, our 1 to 4 segment. But I can't point you to a bunch of people leaving the system, but they must have, because demand didn't go up and supply obviously tightened to drive that sort of quarter-over-quarter increase.
Every channel check we do talking to the largest carriers are telling us how tight the freight market is in terms of recruiting. We had a very large motor carrier said it's been around for decades. One of the largest, has all the advantages, said it's the tightest recruiting market in their entire history. It says a lot for anyone who's been around trucking. And I think, Aaron, the question there is, to your point, the cycle, if you can't get drivers, you're not adding trucks because nobody wants to have unseated trucks.
Right.
Which I think makes the case that the cycle is going to go on a lot longer than I think some of the folks who have been around it for a while would otherwise think.
Yeah, and in the last cycle, and in every cycle I've seen in this industry, it was he who had the cheapest capacity would win, right? You would put somebody in the truck. I mean, think about what we've lived through in these last few years is they would put unqualified, undocumented, unverified people into trucks and almost treat them like indentured servants, which is good for no one. It's not good for highway safety. It's not good for the people being taken advantage of. Now it's so different. I mean, clearly we have what the government's doing, and then we have what the plaintiff's bar is doing and will do, and some of that's good. But it's also very difficult as a business owner when you're getting paid $2,000 to move freight or paying $2,000 to move freight to wrap your head around the fact that you might be staring at a $30 million verdict on the back end of it. despite the best efforts you use. Like it's added this, what we are calling the defensibility of who you hire. And I know you and many others are onto this. And so you're right. I mean, it's one thing to say we didn't see a lot of motor carriers surrender their licenses, at least the ones we do business with, their registration. But it's another thing to say the demand is out there to go get freight at revenue that would be accretive to their bottom line above their cost of capital, but they can't find a qualified driver to put in the seat. And that's a different thing than we've seen in the last several years.
Well, immigration has been is the relief valve. I mean, that's really what's enabled fleets, and we've been talking about it since I was a young boy in trucking, is just how tight the average age of truck drivers of the traditional demographic is older and older. And then what I don't think anyone really expected was the massive explosion of unregistered folks that took advantage of the lack of compliance, the lack of standards, and frankly, the proliferation of freight brokers to provide freight access to these operators. But many of these operators were off the radar. I mean, it's interesting because when the non-domiciled CDL conversation started popping up, I was talking to a lot of CEOs of the largest carriers. They weren't even aware of the term non-domiciled CDL. It never registered them. Very few of them believed it was a real factor.
Yeah, you're totally right. And if you're a shipper who is moving freight, you have to ask yourself, unless it was high value freight, like what was your duty of inquiry beyond the freight broker? I mean, you hired a freight in the instances where you're using brokers, they're the experts, they're on the ground, they're sourcing capacity, licensed capacity. And there was really no need to extend your I mean, I'm sure certain people did, but generally speaking, liability stopped there. And we all know what happened with the Montgomery case. We see what's happening. And so now everybody is paying attention. And when everybody pays attention, it gets harder to operate in the gray areas. And that's what we're seeing. I mean, the numbers clearly support that. With the kind of move we've seen. I mean, diesel explains part of it, but it does not explain all of it. And I just don't see, if we're going to operate in a black and white environment where the cost of doing business is higher and the risk to not meeting that standard is even higher, I don't see how we fall back into the gray area anytime soon.
Yeah, I agree. I want to talk a little bit more about brokerage. And I believe it's true that both your shipment volume and number of invoices, processed, your invoice volume were both up, in addition to, you mentioned earlier, the revenue per invoice being up. What did you see when it came to actually brokerage margin and how they are faring over the last quarter with capacity being tighter, even with spot rates going up from the shipper side?
Sure. Well, in Q1, we saw margin compress because all the contracts broke down. And then in Q2, we saw something interesting happen. And this is where the real world is often more interesting than those of us who sit around and opine and predict. The total gross dollars that a broker was earning per load went up because the load size went up more than their margin compressed. And if you think about that, right, it's the question of, if historically I made 15% on a $1,500 load, well, that's going to be $225 of revenue. If I make 10% on a $3,000 load, my percentage margin went down, but my gross dollars went up. And when you run a business and you have expenses you have to meet at the end of every month, payroll you have to make, percentages are lovely, but it's gross dollars that matter. So because so much freight spilled over into the spot market and the spot market gapped out, even though broker margins compressed to between 10 and 12% for those that we track, the actual dollars they were recognizing per load went up.
So Aaron, one of the things that I think is interesting that you made clear in your comments, John Kingston, our reporter who covers Triumph, pointed out, is that we all benefit when the freight market is doing better. Triumph is one of those beneficiaries as well. But you also made the point to remind your investors that a lot of the improvements you guys have made have been specific to your business. and are not just market driven. Tell us a little bit about those improvements that you guys feel like it really highlights the operating improvements, the unit economics that improvements that you guys have made.
Yeah, I look, if you followed Triumph's journey, what comes naturally to us, or at least what's come naturally to me, is being creative and trying to use what we've built to solve difficult problems that banks never tried to solve before. But at some point, you scale that business to a size where instead of just using technology as doing the next creative thing, we need to harness that technology to make sure we're delivering an incredible customer experience and creating operating leverage. And you and I both lived through the last cycle when people were like, spend faster, spend more, do more. And it's our job to hear that, but not be persuaded by that. And so what we've done is improved our processes. We've upskilled several positions, and we've used technology to create a dislocation between, as revenue is growing, as more invoices are coming in, we're not just throwing people at the problem, because that's not the way you create sustainable margin that lasts through the cycle. And so we've done that. I mean, we've probably eliminated 30 million plus of inefficiencies in the business. We've reinvested some of that into things that we think are going to be revenue producing. And it's been a very healthy experience for us. And it was frankly brought on by a market that was so soft that you had to quit looking outside and you needed to look more inside and find the margin there.
Yeah, it is amazing. Julie and I have talked about this just in our own business, how much better, because we're all forced to make sacrifices, we'll call it, or change the way we think of it, get the business lean and mean, how much better you're positioned as the market recovers, because you're not having to add those costs back. AI, these automation tools that are available has made it so much easier to grow the business without adding humans. And I think that's a testament that certainly shows up in your data.
Mm-hmm.
And there's really not a more, I think, or taxing part of the freight market in terms of human touches than factoring. I mean, that's a part of the business. I was shocked when I came out to Dallas and just saw how many people manage invoices, because the expectation is that factoring should be a pretty easy business. But historically, you guys have had large teams of people that have been required to manage it. What are you seeing in terms of improvements that you're able to use technology to lower the amount of human touches that you have in a factored invoice?
Yeah, well, let me be clear. We still have large teams of talented people, and I think we will forever. My goal is for those people to be talented and empowered in a way that we can continue to grow our factoring business without making that team bigger. But the complexity, the amount of revenue we generate per invoice is somewhere around $25. So every time you touch it, you're losing. Right? We're not talking about tons of margin to go around. We're talking about something that you have to get incredibly efficient at touching something where you're only making $25 in order to do it at scale on a repeated basis. So yeah, I mean, something you wouldn't think about unless you did this for a living. We have an incredible team doing cash application. Imagine a large broker sending us a payment weekly of $10 or $15 million that needs to be applied across 3,700 invoices belonging to 2,000 clients, and you got to go do that $2,000 at a time. Like, that is an incredibly manual, difficult process, and you've got to do it immediately because you've got to apply that cash so your customer can see that the payment came in. And those are the areas where we think automation should materially change the way we do business. And it's just a high volume business that unless you live it and you understand we're trying to get payments out in the same hour that the invoice comes in when we can, it just never stops.
So Aaron, coming off of your earnings call last night, which parts of your business are you seeing the most strength in right now? And then conversely, where are you seeing the most pressure?
Factoring and payments are doing great. Factoring, of course, that revenue is highly indexed to what the average invoice size is, and the average invoice size is perfectly correlated to what revenue per mile is. So that's doing great. Payments continues to scale. We touch 56% or I'm sorry, 65% of all brokered freight. One thing you all might find interesting, we resized the market. There is no perfect measure of what the truckload brokerage market is. When we talk about the size of the market, we're talking about what brokers pay out, not what they charge. And we took it from 110 billion to 135 billion just because everything has inflated. So that business, we're still touching 65% of invoices, I think doing 54 billion in annualized payments. And so that business is doing great. The things that have gone more slowly, our intelligence business, I think we're excited about the products we have, but it's one of those businesses where I think the customer base, there's only so many vendors they want to deal with, and you've got to distinguish your value proposition to them. I mean, you know this, in order to scale that business. And so we've taken more time than I thought to build the products we need for enterprise intelligence. I'm excited about where we are and where we're going from here, but among our transportation-related businesses, that is certainly the slowest growth.
All right, Aaron, I'm not going to let you out of that since you teed it up just scot-free here.
Sure.
You made a big transaction last year. You guys bought Green Screens. It has, in terms of what you paid, big number. By the way, thank you for that, because we like big comps in our industry. As someone who has Sonar, we do compete, in fairness. So my questions are certainly biased in some ways. But in terms of what you paid, where you guys are at in terms of the size of that business today, hasn't really grown year over year. What is the story for the old Green Screens or Triumph Intelligence business?
Yeah, I think Green Screens did a lot of things well. Green Screens was really good at selling to the SMB market of brokerage. Triumph is good, and where we live is in the enterprise market. And so what we had to do, and we knew this was going to happen, we needed to change the go-to-market strategy to meet the needs of an enterprise player. All right, so that takes a certain amount of time. It has taken longer than I would have liked. So, Craig, I've done a lot of deals since I've got into banking. Some deals we bought great. Some deals we bought average. Some deals work out faster than you think, although that very rarely happens, and some deals work out more slowly than you think. And I mean, nobody's hiding the ball. I think that's true of us in intelligence. But I continue to believe that the industrial logic of using the data we have to give insights back to our customers works. And I do believe in the products that we have announced and where we're going. But at the end of the day, my belief only carries us so far. It's got to show up in the numbers. And we don't hide it. We lean into it. Just like we celebrate our successes, we own things that aren't going as quickly as we'd like, but that doesn't change what I think the long-term value proposition is. And so we're committed to go get that.
Well, I think, you should get a ton of credit for what you guys have done in your payments business. I mean, EBITDA margins improvement up 14% year over year in terms of 26% year over year. Load pay is something that I think is really caught on. What exactly is load pay for those that aren't familiar with it?
Yeah, it started as the idea of Venmo for trucking, but it's expanded into a digital business companion for truckers. So it's a place where a trucker can go to consolidate their workflows if they need to upload factoring invoices, if they want to see about equipment finance. It's a virtual wallet for their card. And since it's connected to the back end of our network, we can fund 24 hours a day, 7 days a week. So we don't depend on ACH rails. We don't charge wire fees. We can move money instantaneously. And so when you couple that, the fact that we can do that because it lives inside the walls of our bank, with the fact that our distribution network involves everyone from C.H. Robinson, to several of our partners who are, prefer to pay via load pay to their carriers, that's a compelling proposition. It's a great product. It gets you instant liquidity. And it's a preferred provider for many of the large vendors, and that's why I think it's positioned to grow.
Revenue up 49% for the quarter. That's a fantastic growth trajectory. Obviously, being a bank, you're managing money, and being a bank certainly helps you guys do that for people that can trust that it is going to be safe. You've got the compliance and regulatory elements that you get the luxury of dealing with, having the regulators, but that gives people confidence in the fact that their money is going to be safe.
Credibility.
And I think in this market, with all the fraud going on, I want to know my money's safe.
Yep.
Like it's really important. Aaron, I got to ask, outlook for the rest of the year. How you guys feeling about the market in terms of perspectives on the balance of the year?
Well, I'm just following the Craig Fuller forecast, right? I mean, I'm rooting. You've been right. I think that, and you and I have talked about this, I think the market's better than people think or fear or predict. There are certainly weak patches in it, but there are strong things that are strong. I think it's a very brittle market right now. So any uptick in demand, there's not a lot of available, properly verified, defensible capacity to haul it. So I think that the market risks another leg upwards. In the absence of that return of demand, I still think the market stays strong. And I just want to point out, everybody's like, well, the invoice prices are up 26% quarter over quarter or whatever percent year over year. If this is a healthy marketplace, then the revenue per mile or the average invoice size ought to be at a level where a small carrier can earn their cost of capital while complying with legislation and regulation. And it hasn't lived there for 4 years.
Amen.
So I get it that the numbers look like they're up a lot, but if you inflation adjust those numbers, if you allow for what diesel's done, equipment input costs, small carriers still are not pocketing a lot of money here.
Aaron, you're
So
exactly right. And we have a regulator, the FMCSA and DOT, that are actually watching the freight market data. I mean, they are now a subscriber to Sonar, tracking the rates, tracking the market. And what they will say, very similar to the STB, what they'll say is, we want motor carriers to make a profit because we want the ones that are compliant to be profitable. We want the market to be healthy because we know if it's healthy, it will be safe and secure. That is directly from Derek Barr's own words. And it's unusual to have a regulator tracking trucking that cares about the freight market, which I think is pretty remarkable. Sean Duffy and the Louisville Truck Show said the same thing. And I think that's why you got to make the bull case on the market that this cycle is not going to turn over anytime soon. I think the fact that the regulators care about where the market is and market health is something we have not enjoyed, frankly, forever.
Forever.
Well, Aaron, thank you so much. Congratulations on a fantastic quarter. I think a lot of confidence in what you guys are doing there in Dallas. We'll have to come visit. We've talked about that.
Yeah, Dallas.
I do love going to Dallas. Mm-hmm. So, Aaron, appreciate it.
Don't come in July.
Oh gosh, yeah. Let's wait until it cools off. Yeah.
We got to do it. I got to go to the Baylor. He's a Baylor Bear. Aaron, that's one of the smartest executives in the space. All the smart executives go to Baylor or went to Baylor. So all of them.
it.